to have with us here Keith Rosenbloom, who we've known for several years, going back to some really interesting stories. One I was just thinking about, one of my favorite stories I ever wrote was called The Myth of Ashland's Superior Shareholder Returns. I don't think I actually talked to Keith about that, but he was involved in that. So anyway, the theme of this panel is how Keith can make you money. So he's going to give you some good tips. Again, Keith's the managing partner of Cruiser Capital. He's been an investor for a long time. He's a sometimes activist, not always, and a number of campaigns he's been involved with, which we covered actually, Ashland along with Schulman and American Vanguard. So Keith, thanks for joining.
Thanks, appreciate it. Yeah, we are a sometimes activist, so I thought I'd bring my white hat for all those in the room that know that we're the good guys. We're not the bad guys, the barbarians at the gate. Yeah, Cruiser is a investment firm. We manage a fund, actually two funds. We manage accounts, and we form special purpose vehicles often when we have an idea that we're highly convicted in. And the essence of our investment thesis is we believe that governance matters and leadership matters and that people matter. And usually we look for companies that have really great management teams that are on the cusp of something interesting. And we try to become highly concentrated or highly invested in them. And when we think there's a great situation that needs a catalyst, that's often when we will try to be constructivist, make certain suggestions to the company, and when they don't, then I guess we go activist. When we talked, what I thought would be interesting here, again, we manage money for clients, so you're not our clients, so I'm not giving investment advice, but I can give you some thoughts on two very large positions that we have that have performed extremely well for shareholders, and I think will continue to perform extremely well for shareholders. And they did so acting in the best interests of all of their stakeholders without a public activist fight. But through lots of discussions, one of which I was privy to, and another which I'm fairly certain happened, those companies created a lot of value. So if you want, I can talk about those.
Yeah, let's go for it.
Okay, so which one to start with? So our largest position in our fund is a company called Fortress Transportation and Infrastructure. It used to be called Fortress Transportation and Infrastructure Partners. The difference was, as a partnership, it was an LP, the business couldn't be owned by a lot of people. Couldn't be owned by any of the indices. Couldn't be owned really by a hedge fund that was creating a K1 because it created a K1. And even though we really liked the business a great deal, its structural formation prevented an unlocking of value that we saw. And so, and full disclosure, okay, full disclosure, the stock today with a spin that occurred is at $43. It pays a very juicy dividend. Dividend adjusted, the last 7 years, I think our basis is $1.84. So it's been a huge winner for us. I'm talking my book, blah, 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 blah. You can decide that you want to discard it. But the reason why I think it got there, and the reason why I think it's got interesting things going forward, is because the management team took an approach that recognized what was preventing growth and accrual to shareholder values, to shareholders, and tackled the problems and the issues head on. And I think that's something that you would like to encourage a lot of people to do. So that business is interesting. They are in the airplane leasing business. That's ostensibly what it was. When it came public, it had a mixture of other assets. It had a whole bunch of real estate and a bunch of railroad assets and properties. It sort of didn't make sense as a pure play airplane leasing business. And so that gave it a conglomerate discount, if you will. And that combined with the limited partnership structure really prevented anyone from sort of seeing what the pure business was. And after a couple of loud conversations that we had with them, and I'm sure many other investors did too, they took a very responsible tact on how to separate the businesses and think about what shareholders wanted. And in the process, they unveiled a really interesting line of business, which is as they lease out engines and they bring them back, they have to repair them, right? That's a business. There's a company located 30 miles south of here called Heiko, which the Mendelsohn family has built from a business, I believe, from $1 to $300 in value. And that is and their business is creating pre-market approval airplane parts, which they sell to airlines and the military. Fortress has the same business. They refurbish engines, mostly from Rolls-Royce and General Electric. And they realized that when people brought the stuff back to the shop, the most important expensive element of the repair wasn't the labor, it was the parts that they would have to buy from Rolls-Royce and General Electric and Siemens at really high markups. And they felt that if they did what Heiko did, which is basically create their own parts to be able to load into the engines, they could sell them to their clients at a much, much lower price and still have a huge markup. So they're in that process. They've indicated that they will. And if they do, then this business, which is going to generate about $500 million of EBITDA, thinks very credibly that they could do $1.4 billion in EBITDA in about 2 years. It's interesting. And the valuation here, I think, is at 9 times EV to EBITDA. So you sort of get a play on that, and it's paying a nice dividend yield. So we like that situation. We think it's a good example of a board thinking about how to correct value. And for those reasons, we like it.
I like that. Now, Keith, on a different note, as a sometimes activist, when do you decide, I mean, is it at the point when you get frustrated, or is it before you make the investment? When do you decide this is going to be an activist position for Cruiser?
Yeah. So we really pride ourselves on interacting with management and trying to talk to the change makers in a constructive fashion. And I think that that's really important. Some people call it a private equity approach. I don't know what you want to call it. But we're very cognizant of the fact that we're minority investors. We don't have control. But we also have liquidity, which is an advantage. So we go to management teams and we say, look, your margin profile is less than where it could be. It's less than these peers. You have a business, I'm making all this up now, but it's not a bad example. You have an asset here that appears underutilized. Let's talk about it. Or 2 years ago you said you were going to do this, but you wound up doing that. Why? When you said you're going to do that, that sounded pretty good. But you deviated. Why did you deviate? And I have to tell you that 95% of the discussions we have with management are really productive. And most CEOs and chairmen of public companies who are invested in their own stock really want to hear from shareholders. Like, it's something that they rarely do. Boards writ large rarely talk to shareholders. And I think when they actually get constructive feedback, responsible boards really appreciate it. And so that's been our very positive experience. And the very few cases where we have been shown the door or gotten stiff-armed are those cases where you have very adequately and forcefully covered a couple of those cases. It's where we've had to basically shine a light on the facts. I mean, all activism is, shareholder activism is sort of amplifying the truth, right? If somebody has taken down guidance 6 times in a row, maybe shareholders should appreciate that guidance has been taken down 6 years in a row, or maybe there isn't good corporate governance here, or that's all activism ultimately really is. And then it's up for the shareholders to decide, what they think.
Keith, something that I've discussed with you in the past, want to get back to quickly here is when you give advice to companies or your opinion, some of these companies don't really have much research coverage. Is that fair? So you're kind of the only outsider that's telling the company what you think, right?
Yeah. I mean, I think that's really interesting. Look, the average market cap of the Russell 2000, so let's say there's actually more, but let's say it's 2,000 companies, is $960 million, okay? The largest is over $9.5 billion. Think about that for a moment. The vast majority of those publicly traded companies are really super small. They're under $800 million, let's say, of market cap. And it doesn't really pay for an investment bank to deploy real analysts to cover them. It just doesn't make any sense. You can't get paid back on commission volume or investment banking business. So most of these companies, particularly if they've been public for a while and they haven't done investment banking business, get very little coverage. And so back to this point about, I think boards should really embrace shareholders who spend the time to think about ways to improve the business, particularly if they have no research coverage. To me, it's self-evident. And when you find, I think we're like 10 for 10. Every time we find a CEO who says, I don't really need to hear from you, I know what I'm doing, and it hasn't worked for shareholders, that's usually a problem.
Great. I've got a quick question on ESG-based activism. Keith, I remember looking at one of these situations you were involved in, and it was a pesticide company. And I thought,
Yeah.
Keith, is there anything to talk about here as far as environmental damage and so on? And you said, that's not really what I want to focus on. That wasn't the argument that you were making.
Yeah. First of all, I'm on the board of that company, so I can't really speak about it. But that's not kicking the can down the road. I would just say this. In terms of ESG, the most important letter in that acronym is the G, is the governance.
Agreed.
Because the E and the S should follow proper governance. And today, you bring up a pesticide company, but it's really with any company, a packaging company, a carbon business. The E and the S are table stakes. If you don't have an environmental statement and an environmental plan, and you don't have a sustainability statement and a sustainability plan, then I think you've missed the boat and you're not doing your job. And that's driven by governance. And now, you'll really see it, I think, diverging between those companies that care and those that don't. And, I think the vast majority of them do care, Do you want me to give you one other? Can I give you one other stock or interesting thought?
Yeah. We got a couple minutes.
Okay. There's another company, which, again, we had nothing to do with, but we own, and it's a good position for us. The symbol is CRH, and it's called CRH. And it's the largest aggregates producer in the United States. So roads, outside, that's what they do. And what's interesting is it trades at 7 times EBITDA, but it was listed on the it was listed on the London Stock Exchange until September 25th. And it has now, although 75% of its business is in the US. So the reason why this is interesting is it was trapped in Europe, even though most of its stuff was in the US. Because it was trading in Europe and domiciled in Europe, it couldn't be in any of the indices. It couldn't be in the S&P, it couldn't be in the Russell, it couldn't get any of these natural buyers. And all the analysts that covered it were kind of European construction analysts, not sort of US aggregates analysts. So I was not privy to any of these conversations, so I know Bloomberg's in the room. Adam, I don't have inside information here, but my sense is that there were some very thoughtful shareholders that discussed with management how to unlock value. That's my sense. And they did. And what's interesting about it today is it trades at 7 times, as I mentioned. The public comps in the US trade at 14. It's a big disparity. Not saying it should trade at 14, but I don't think it should trade at 7. It's a big disparity. And it cannot be listed in the US indices until they file their 10K, which happens in February. So I think this company is going to get a lot of attention. I think there's going to be a lot of interest in it. I can talk about some of the other things they did to unlock value, but at a very big level, you like it. And if anyone wants to do their own research, on September 24th, they had an investor day, and it was really superb and clear, and you got a real sense for where their focus was. And if you look at their compensation package, I think it dovetails nicely with it. Anyway, so that's another big position of ours, which we had nothing to do with as an activist or constructivist, but we were able to, I think, do good work and observe that the business is being driven on proper, governance.
Great. Any questions from the audience? If not, I've got one quick one for you, Keith. So, Keith, you focus, we were talking a minute ago about companies that don't have, much research coverage. Do you think that in general in your world there's more opportunity at smaller companies? I mean, I see some of these, the big outlets are going to be all over it if somebody goes activist in Nestle or Procter and Gamble, but look, they have like 25 covering analysts. What is there not to know about companies of that size? I mean, I feel like if you guys roll up your sleeves and you're looking at a company that's not followed as widely, does that give you, all else equal, a better opportunity than you would in a big company?
Well, this is a bigger question, and it's really important. Traditionally, it was always thought that smaller companies had bigger and better growth profiles. And that was the thesis behind investing in small cap companies. The reality of a small cap company, particularly today, is it's really challenging. Your cost of capital is so much higher than larger businesses. Your ability to get attention from public investors is so handicapped versus everyone else because of liquidity, because of the indices. If you look at a company, let's say, that does 100 million of EBITDA as a public company, there is a 95% chance that $10 to $20 million of its cost structure is tied up in being public. Just think about that for a second. 10 to 20% of its earnings are dedicated effectively to the fact that it's liquid, but no one gives it any benefit for being liquid. So you contrast that with if that company were private, where in our hypothetical situation that $10 to $20 million now goes to shareholders as opposed to public company costs. It's an extraordinary disparity. So I think that the hurdle for investing in small cap companies is really high. And I just want to call out that Steve Warner is in the room. Steve Warner is a mentor of mine. He was one of the founders of Merrill Lynch Venture Capital. And when the venture capital world took place years and years ago, it was very different than it was today. Today, back then, you could infuse $10 million in a business plan, and a management team felt enabled. They could get a lot done. Today, venture checks can be $100 million. What was the market cap of many exits? So it's a very different world, and I think that when you're looking at small cap companies, you really have to have much higher hurdles, and I think you have to put real filters on when you're looking at what they communicate to you.
All right, great. We're going to leave it there.
Wait, I just want to say one thing.
Oh, okay.
Sorry. I'm on a panel later, but I just want to say one thing. Hey, give me a microphone. I wore a tie and everything. So our business, we have a code of ethics in our business. And that code of ethics, all of our employees sign it. It's shared with all of our investors. They can request it at any time. And the code of ethics doesn't have, or it's very good, don't get me wrong, but it didn't have a morality provision. And with all that's going on in the world, we talked about it internally, and we decided that we would put a moral provision in it, a morality provision in it. So I'm not soliciting investors, but I would tell you that if you did invest with us, you will find a moral provision, a morality provision. And I raise it because you all run companies, and I wonder if it's an interesting thing for you guys to think about as well. The goal is to make sure we don't hire people who are amoral or people who are immoral. I'm in the business of managing people's money. That's a really trusted responsibility. I care a lot about it. I don't want anybody working with me or working for me that doesn't have the same moral code that we do. And so I hope you all do become investors of Cruiser Capital, and you will see our code of ethics. But I'd love you to think about it for your own businesses, about employing it. I just think it's really important. Again, leadership comes from the top.
All right. Thank you so much, Keith. That was terrific.
Thank you.